All right. It's Monday morning, and it's that time again for a Monday market update to see what's going on out there and how it will affect your business as realtors and builders, as well as your experiences as home buyers in the upcoming market here. So, on the books for this week, we're going to continue to absorb all the tariff war stuff. Sometimes it's on, sometimes it's off. There's a reprieve now. It's a bit overwhelming to say the least. I'm not going to bore you to death with all those things. Small business optimism from NFIB comes out on Tuesday. It's a survey that measures small business owners' feelings about what they're doing and what their orders are, and then how they feel about their business going forward. The biggest issues for this week for us are the CPI, Consumer Price Index, and the PPI, Producers Price Index, that measures inflation at a consumer level and a wholesale level. That's Wednesday and Thursday. I'm expecting both of those to remain flat to slightly elevated as this inflation is not leaving us anytime soon. As well, the initial jobless claims are going to come out on Thursday, which will be interesting to see what that is, and nothing's going on Friday. However, something is happening. Axios reports as of last week that Americans are now behind on car payments at record levels. This is, as you can see here on the screen, I've got a little canary in the coal mine here. This is a canary in the coal mine for our economy. Folks tend to take care of their cars, right behind taking care of their rent and their mortgages, right? So they pay the rent and mortgages first, then they always pay their car payments. So as you can see, subprime car loans, these are for folks that are buying cars and borrowing money with a credit score less than 680 typically, are up 6.6%. And that's pretty magnificent, even if you go back to 1996, 1997. So that's not a very good sign at all. Prime borrowers, folks with credit scores in excess of 640, are sitting at zero point 0.4, which typically, if we even go back to, COVID days or post-COVID days, it was lower than that. So that's interesting. With an unemployment that is as low as it is for these lates to be where they are, it definitely does show some consumer stress indicators. Now, rising repossessions and all that will cause used car prices to decline, but whereas that certainly is a good thing inflationary wise on the surface, there's lots and lots of folks that bought these cars at their absolute pandemic price highs, and they could be underwater with what it is that your car is worth, because the market is not going to get flooded with cars just like yours. Now, you bought the car very high, you're paying your payments, you're not getting repossessed or anything like that, but those repossessions will have an effect on the value of your car, much like the homeowners went through back in 2008. And it's also really a higher delinquency rate suggests that wages aren't keeping up with the inflation, that folks, that their savings are being depleted, and that credit cards are being maxed out. We already know we are at the highest levels of credit card usage right now at $1.2 trillion in debt. So this is going to be an interesting thing to watch, and hopefully this is just a blip on the radar and nothing that will kind of continue onward. So we'll see how all that goes. So what does this mean for mortgages, you ask? Well, here's the market. The market is absorbing kind of what's going on. We had a great pickup last week. We kind of started to bounce off of this thing. We lost a fair amount of ground, and today we're kind of up. This is going to be really a tale of two things, guys. It's going to be a tale of how the tariffs kind of sit and get absorbed at some point in time. You see your 401k and your investment accounts and what it is that they're doing in the S&P 500 and the NASDAQ losing as much as it's losing. And really the reasoning behind that is that folks are cashing out their accounts and moving their money into these bonds. That's why you saw the pickup that you saw like that. This is just money's coming in from stocks into bonds for their safety. That's all that this is. And so we don't know exactly where any of this is going to end up. This is where you really need a good quality loan officer who can give you advice and get you locked in once you're under contract at the right time, so you can optimize what it is that we see in the marketplace, but also not risk losing what it is that you have in the marketplace. What does that look like for rates? Well, we were at 6.6 last week. Today, we're sitting at 6.72 national average, 6.97 for the jumbo. So they are up just a tick, but still below 7 across the board, which is fantastic news, and we welcome it. So let's see how all of this can last. Remember, there is an inverse relationship between stocks and bonds typically, and that's why you're seeing the shift for the rates coming down, is that there is that injection of money coming over. Okay? Hope that helps. As always, please do subscribe, like, comment, and share so others can be as smart as you are. As always, I'm just a phone call away if you guys need anything and need to strategize on your specific situation. Good luck to you out there. Bye-bye.